Disclaimer, this video is intended for educational purposes only. Neither Zoom Mortgage nor Pacific Coast Capital Markets are investment advisors. Any information contained in this video should not be considered investment advice. Hedging real estate risk. This video is being completed on November 2nd, 2021. And we're going to look at the favorable trends in real estate, which basically are very tight housing supplies across the country. Supplies down 24.8% nationally, September 21 versus September 2020. The unfavorable factors are all exogenous factors, starting with Fed policy tightening into an economic slowdown. We'll get to that later. QE tapering in 2021 into 2022. And then after QE tapering, the expectations for a Fed funds rate hike late 2022 into 2023. Additionally, we have a global credit contagion concerns coming from China and Evergrande construction. And then most recently, there's been a slight downturn in the Case-Shiller futures. Is this a blip or a preview of events to come? First off, looking at the positives. The local housing markets in September have experienced major increases in price changes year over year. The key points are inventory is still very low, and inventory in most areas is at a record low for the month of September. There is significant divergence between various markets across the country, and it is possible that inventory will be up year over year during the winter, but will still be at very low levels. Active inventory for local markets in September 2021. You can see across the country the various markets, and as an aggregate, the inventory is down 24.8% across the country. Moving on to the Case-Shiller futures contracts, this would be the vehicles that would be used for hedging a real estate portfolio. This information comes from John H. Dolan. He's a market maker on the Chicago Mercantile Exchange, the CME, and his blog is at www.homepricefutures.com. You can be reached at email at johnhdolan@homepricefutures.com. Understanding futures nomenclature. Every futures contract has three components to it in the contract quote. It has the underlying index, it has the month of expiration, and the year of expiration. So for example, if we go to the bottom, the San Francisco contract is highlighted. You can see SFR, which is San Francisco region, the G, which stands for February, and then finally the year, which would be 2021, 2022, 2023. This particular index, let's go down to the February 2023 index, or 2023 futures contract, and it has already rolled over. At least it's pulled back over the course of the last month. It's down 5.4 points on the bid and 9 points on the ask. Each point is $250 per contract, and the CME initial margins are $2,150 per contract. The underlying index is based on the San Francisco region, and it has, and you can see if you're hedging a Seattle or group of Seattle properties, you can see that the closest correlation with Seattle comes from the San Francisco region, and there's a 94.96% coefficient of correlation.
How big of a bind is the Fed in right now?
This is, we're in extraordinary times. If you look back at early 2008 and 2009, there were three other instances in the aftermath of the financial crisis that we had 6 consecutive months of falling car sales. There's clear, so we've never seen this outside of a large recession. This is clearly more than a semiconductor story here. We have housing that is beginning to roll over as well. And many other signs are proliferating worldwide that global growth.
How big of a bind is the Fed in right now?
This is, we're in extraordinary times. If you look back at early 2008 and 2009, there were 3 other instances in the aftermath of the financial crisis that we had 6 consecutive months of falling car sales. There's clear, so we've never seen this outside of a large recession. This is clearly more than a semiconductor story here. We have housing that is beginning to roll over as well. And many other signs are proliferating worldwide that global growth is slowing. There's a bottleneck recession that's very obvious. It looks like we might be headed into an industrial recession as well. I'm going to be paying close attention to Germany's business confidence data that come out later today. And on top of that, it looks like we're also going into an earnings recession. So there are a lot of slowdown indicators, and yet we have runaway inflation. We have every sign that this bottleneck recession is global in nature. And what a lot of people are not talking about is that in exchange for working 24/7 at the biggest ports on the West Coast, that there might be a lot of payback coming into July the 1st of 2022. We could be talking about a big strike among the longshore workers, among port workers, and really that's on nobody's radar screen. If we start to hear rumblings about that, you will really see inflation be persistently higher, and it's beyond the middle of 2022 we're talking about here.
But you constantly, you hear a lot of guests on the show say this is a supply side issue and the Fed shouldn't really be reacting to it. And yet you see markets are pricing in several hikes by the end of next year. Do you think that the market is right on that call, that they're going to have to hike a little bit more faster to deal with these inflationary pressures?
Well, there was always going to be payback in some form for the Fed getting so far behind the curve, for the Fed refusing to start tapering, especially its mortgage-backed securities purchases, even as home prices ran amok. So I don't think that the markets are necessarily incorrect in what they're pricing in. That said, I could still see, I'm going to speak out of the other side of my mouth, I could still see the Fed prematurely pulling the plug on tapering if it slows the markets enough. That's why I say it's going to be a policy error or a policy error. It's very difficult to tighten into a slowing economy, and yet it looks like they're going to be forced to do just that. But fighting stagflation with the current tools in central bankers' toolboxes, it's not an easy thing to do. Stagflation is a different beast.
It's fair to assume that the Fed may have to tighten more aggressively than what's been factored in. How do you hedge against that?
It's a very difficult place to be, especially headed into a midterm election year that is promising to be very contemptuous. It's going to cause a lot of headline risk going into 2022. If you look at what happened in 2011, 2012, and 2013, consumer staples, gold, these were long maturity bonds. We're seeing a flattening of the yield curve, but that's because we're seeing shorter maturity rates come up, even though longer maturity rates seem to have found something of a ceiling. Again, these are signposts of stagflation, but your longer maturity bonds did outperform in such an environment. If we look back to the last time there was this much political rancor at the same time of economic upset in the U.S. economy.
Is it inevitable that higher yields will lead to lower stock prices? That's not reflected in the equity markets right now.
There's not much reflected in the equity markets right now. I think what we're seeing is the power of passive investing, which is enormous because of the way by which many American workers' 401ks feed into the stock market. Every single time they get paid, there's money that's pulled out. The multiplier effect is estimated to be somewhere around 17 times. Share buybacks are pushing record levels, and you've still got the Fed pumping $120 billion worth of liquidity into the stock market. So there's a massive offsetting force that helps explain why stocks seem to have a floor underneath them. But again, all of these things can change if the perception even begins to emerge that especially junk bond issuers are going to have a harder time accessing capital markets at a time when U.S. corporate debt has exploded from $10 trillion prior to the pandemic to pushing $11.5 trillion. If you add high yield bonds together with leveraged loans, you've already passed a $3 trillion milestone. There's a lot of debt that's still in the system. Credit is still an issue. And I think that that's where you would look for the first crack, because that is what we saw in 2018. We saw a credit market event spill into and bleed into the stock market.
What's also changing is the energy space, this credit crunch, and we're seeing oil, surging ever closer to $90 a barrel. How might this play out? Who might get hit? Which asset classes are you looking at?
Well, I think it's fairly obvious that consumer discretionary, and again, consumer discretionary deeply underperformed. Small cap stocks underperformed with similar backdrops. $90 a barrel is really going to start to cut into U.S. consumers.
Okay, some quick notes coming from the DiMartino interview. First off, we've got 6 consecutive months of declining car sales, which has presaged virtually every economic decline in the last 20 years. We've got housing rolling over. Global growth is slowing, no question about that. We have a bottleneck recession that we're seeing at our ports, heading into an industrial recession, quite possibly, and going into an earnings recession for stocks. Yet at the same time, simultaneously, we have runaway inflation, and this looks like payback for the Fed being so far behind the curve, and they have to catch up with inflation. That has to be the priority, even though it does look like we're heading into a slowing economy. So it's forcing the Fed to tighten into a slowing economy. And then finally, there's a potential for a dock worker strike coming in July of 2020. And we'll just kind of cover a little bit of old ground real quick. We had put together a video that remained internal back in September, and that video included this chart, which was we see the lows in rates on March 9th, 2020, with the COVID pandemic basically being announced to the markets. We had a secondary low in rates occurring on August 6th, 2020, and using those lows in interest rates, the subsequent rise, the high in rates that came on March 30th, 2021, and then the subsequent pullback into July 20th, 2021, provides us with a reasonable target of 2.495%, 2.5% on the 10-year Treasury. And again, going back to our previous video, we did see a breakout coming in the Treasuries. This was as of September 23rd, 2021. You could see that breakout that was occurring right at the very end. And this will lead us into the next chart. And with our next chart, we can see the breakout did get accomplished. And it does appear that we have the breakout potentially completed. It's going to be very interesting. This is as of November 2nd today, earlier today, and we do see potentially that we're getting a bit of a pullback in rates. That would be good news, but this is going to be highly contingent on Fed policy changes, and that should be announced tomorrow on the 3rd of November. And just a quick reminder coming from the September 23rd Fed meeting, here's a visual of the Fed dot plots coming from the previous Fed meeting. Which leads us into the Fed QE taper projections. Remember, QE taper is consisting of both Treasury notes and bonds that are being bought by the Fed, as well as mortgage-backed securities. So it does look like we're going to begin tapering in November. We'll find out tomorrow exactly when this is going to begin. Excuse me, I should say December. And if all goes according to plan, the QE tapering will be completed by July. And then finally, this leads us to just a quick reminder of the potential contagion that is coming out of China, and the potential for this debt crisis to metastasize. That's the big risk, and that's the interesting part going forward over the next several months. I want to thank you for watching this video. If you do have any questions, please feel free to contact us, and we'll be happy to discuss any questions you may have. Have a great day. Take care.